Hello everyone. Last quarter has been quite eventful with both global and domestic parameters changing. In US basically we saw US rate being very volatile between say 50 to 60 basis point. Gold was making headlines at historical high levels. Coming domestically, we had liquidity situations, RBI intervening to ease out the liquidity situations, and couple of more parameters like borrowing calendar and all, which I will discuss in detail as we go forward. As we go to US yields, basically in US we saw yields in the beginning of the quarter around 460 levels, which came down all the way to almost 4%. Why it was higher is basically because the data on growth or the data on basically employment was really very robust, because of which the expectation of rate cut got delayed, and that's how we saw yields going up. But at the same time, the expectation of Trump tariff getting implemented over a period of time, which got implemented in the beginning of FY26, that is April 2025, and basically post that the expectations of recessionary situation in US developing increased, and that's how we saw yields eventually coming down, and as we speak it's almost close to 4.05%. Gold or precious metal, so to say, gold and silver typically made a historical high levels, and typically because of the reasons like finding an alternative currency in the global trade wars or geopolitical situation, I think gold was the most favored asset by many of the central banks. Coming back to the domestic harbors, basically on the liquidity front was the main attraction of the entire quarter, wherein we saw, say if you go back to FY25 third quarter, the liquidity reduced from say almost 3 to 4 trillion to almost neutral or slightly negative. RBI in fact intervened immediately with measures such as CRR, open market operations, FX swaps, VRR, and totally they infused till date or almost by the end of last quarter is basically around 8.5 to 9 trillion, which brought the liquidity to around neutral levels to slightly positive levels. In addition to this, we had two major events, one from Government of India and one from Reserve Bank of India in form of budget as well as policy. And in both this event, we saw growth supportive measures from Reserve Bank of India as well as Government of India in terms of rate cut after a considerable period of time, liquidity measures already they were taking, and from Government of India we saw focus onto capex and consumption, which in a way will support growth as we go ahead. From a policy perspective, inflation expectations from Reserve Bank of India is on a downward bias, and expectations are around 4%. Probably we might not see any negative surprises from inflation going forward. On the growth front, yes, the expectations were around say 6.5 when the policy was announced, but as we look at global parameters on the trade war developing, we might see some bit of impact coming on to our domestic growth. That's what raises my expectations on RBI maintaining their softer stance on monetary policy going ahead. A couple of more factors like how the demand supply situation pulled out during the quarter. Basically what we saw in Q3, though we have seen FPI outflow starting from Q3 overall from debt and equity market both, but from a debt perspective, what we have seen both in Q3 and Q4 of last financial year is basically there were flows not as per the as high as expectation, but yes, there were positive flows as far as debt markets were concerned. Also, one of the startling feature of the quarter was announcement of borrowing calendar for the first half of FY26, wherein we saw the focus shifting from very long end of the curve to the belly of the curve, which was welcomed by the market, and also we saw market reacting positively to it. So in brief, if I have to consolidate all these moves, Basically, from 1 month to 30 years, entire yield curve or the yields basically went down by ranging from say 15 basis point to 50 basis point. From a view perspective, clearly going by all these measures, I feel yes, we are on a downward trajectory as far as interest rates are concerned. Already we have seen lot of RBI measures coming till date. I think this thing will continue, and the impact of this will be obviously yields going down, compression of spreads, and basically steepness in the current yield curve, which is very flat. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.